When a $3 million portfolio drops, say 15%, you are looking at a $450,000 paper loss.
Yeah, which is a massive number.
Right. I mean, that is nearly $500,000 just evaporating from a balance sheet in the span of a few weeks. It changes the psychology of investing completely.
Oh, absolutely.
Mass market financial advice assumes you have, a few $1,000s in a 401k and decades to just let it ride. It
Right.
tells you to simply close your eyes, ignore the statement, and trust the process.
Which is fine for a 25-year-old.
Exactly. But when we are talking about a multi-million-dollar portfolio that you actively rely on for your livelihood, well, closing your eyes isn't a strategy. It's a massive, unmitigated risk.
It is, because the math at that level of wealth interacts directly with your immediate spending requirements. You aren't just accumulating wealth anymore, you're distributing it.
Right.
And a drawdown during the distribution phase requires a fundamentally different set of mechanics than a drawdown during the accumulation phase.
Okay, let's unpack this. We are digging into a highly specific playbook today for our deep dive.
It's a really fascinating one, too.
Yeah, it's sourced from Thomas Davies of Davies Wealth Management. They're a fee-based fiduciary firm down in Stuart, Florida. And this material, which often anchors their 1715 Treasure Coast financial wellness discussions, is titled Navigating Market Corrections: 7 Proven Strategies for Portfolios over $1 million.
And I love the core premise here.
Yeah.
Yeah, it's about treating a market correction not as a failure of the financial system, but as a, completely predictable mechanical event. By definition, a correction is just a 10 to 20% decline from a recent peak.
Which historically happens roughly every 1 to 2 years. It's totally normal.
Exactly. What's fascinating here is how the playbook shifts the perspective from defense to offense. But, and this is the big but, only after the defensive architecture is absolutely impenetrable.
Because you can't capitalize on depressed asset prices if you're forced to sell those very assets just to keep the lights on.
Right, which introduces the concept of sequence of returns risk. I mean, that is the single most destructive force for a high net worth retiree.
Okay, let's lay out the mechanics of that risk because it is incredibly insidious. Imagine a retired couple with a $4 million portfolio.
A very common scenario.
And they withdraw $200,000 a year to cover their lifestyle, which is a 5% withdrawal rate.
Pretty standard, yeah. Sustainable in a flat or growing market.
But if a 20% market decline hits early in their retirement, that $4 million portfolio suddenly shrinks to $3.2 million.
And they still need that $200,000.
Exactly. They still need it to pay property taxes, cover health care, buy groceries.
Right. And because they still need that fixed dollar amount, their withdrawal rate instantly jumps from 5% to 6.25%.
Wow.
But the percentage isn't even the most damaging part. The real damage is that they are being forced to sell shares at a 20% discount just to generate that cash. So when the market eventually recovers, those shares are gone. They cannot participate in the rebound. They have permanently locked in the loss, which permanently impairs the portfolio's future compounding ability.
To counter that, the Davies playbook insists on building a very strict liquidity architecture.
Yeah, and this isn't just about throwing some money in bonds.
Right. It's a deliberate 3-tier system designed to completely sever your daily cash needs from the volatility of the stock market.
The structure is highly systematic. So Tier 1 is the operating cash layer.
Okay, what goes in there?
This is strictly 6 to 12 months of anticipated spending held in the most secure, liquid vehicles available. We are talking money market funds or treasury bills.
Stuff that won't drop in value.
Exactly. It yields something, but its primary purpose is absolute principal protection and immediate access.
Then you move to Tier 2, right? The income buffer.
Right. This holds another 1 to 2 years of spending needs.
So you step slightly further out on the risk curve to capture a bit more yield here.
Yeah, utilizing short-duration bonds or carefully structured CD and treasury ladders.
So it is still insulated from equity market volatility, but it provides a bridge.
Exactly. And that bridge protects Tier 3, which is the growth engine.
The actual stock portfolio.
Right, the long-term equity. The structural rule of this architecture is that Tier 3 is never touched, under any circumstances, during a market drawdown.
But wait, I have to push back here. There is a massive opportunity cost to the structure, isn't there?
How do you mean?
Well, if you're holding up to 36 months of your living expenses in cash and short-term bonds, you are structurally dragging down the overall yield of the portfolio. In a raging bull market, that much liquidity is severely underperforming equities.
I mean, you're not wrong. It does underperform equities during a bull run, but you have to view that drag as an insurance premium.
An insurance premium for your behavior.
Exactly. Fidelity's research on market cycles demonstrates that the vast majority of market corrections recover within months, not years. By walling off 12 to 36 months of spending, you fundamentally alter your own behavioral psychology.
Oh, I see. A market drop transitions from an existential threat to your lifestyle into just, mere background noise.
Precisely. The urge to panic sell is totally neutralized because your immediate future is already funded.
Because that 3-year cash buffer prevents you from panic selling, it actually gives you the psychological space and the mathematical leverage to look at the red numbers on your screen as an asset.
Which is a huge mental shift.
Right. Here's where it gets really interesting. Once the defensive perimeter is secure, a market correction opens up highly specific windows for tax optimization.
This is where we get to the concept of tax alpha.
Tax alpha, I love that term.
It's a great concept. The goal isn't just to ride out the storm. It is to actively harvest the volatility to generate tangible tax assets.
Through tax loss harvesting.
Right, that's the primary engine here. You deliberately sell positions that are currently trading below their cost basis, locking in the loss, and then immediately reallocate that capital into a highly correlated asset.
We need a better way to visualize this than just selling losers. It's more like crop rotation in agriculture.
Okay, I like where this is going.
You pull up the failing crops to clear the field and lock in the loss for the IRS, but you immediately plant a slightly different seed in that exact same plot of land.
Right.
So the field stays fully productive, and when the rain comes or the market recovers, you capture the full upside.
That is an apt way to describe it, but the IRS is very strict about what kind of seed you can plant.
Right, the wash sale rule.
Exactly. This raises an important question regarding execution, specifically the wash sale rule found in IRS Publication 550.
Which is a major trap.
A huge trap.
Yeah.
If you sell an S&P 500 index fund at a loss, and then buy that identical S&P 500 index fund within 30 days, either before or after the sale, the IRS disallows the loss entirely.
So you suffer the economic pain of the drawdown, but you forfeit the tax benefit.
Exactly.
And it isn't just identical funds, right? The language is substantially identical.
Right.
So you can't sell a Vanguard S&P 500 fund and buy a Fidelity S&P 500 fund. The IRS sees right through that.
They absolutely do. You have to swap into something correlated but legally distinct.
Like selling a large cap blend fund and buying a large cap value fund?
Yeah, or utilizing direct indexing separately managed accounts where you hold the individual stocks rather than a commingled fund.
Which is why this is not a manual do-it-yourself exercise for a portfolio of this size.
No, not at all. For a $1.5 million taxable account, a standard correction can easily surface over $100,000 in harvestable losses.
Wow.
And those losses are incredibly potent. You could use them to offset capital gains generated elsewhere.
Like if you sell a business.
Or if you're diversifying a concentrated stock position.
Yeah.
Plus, you can carry them forward indefinitely into future tax years or apply up to $3,000 annually against ordinary income.
That tax utility ties directly into another offensive strategy the playbook highlights, which is supercharging Roth conversions.
Yes.
Now, our audience knows the basic mechanics of a Roth conversion. You shift funds from a traditional pre-tax IRA to a post-tax Roth IRA, paying ordinary income tax on the converted amount today so that all future growth and distributions are tax-free.
Right. The standard logic is to execute conversions when your income is lower than usual. But during a market correction, you are essentially converting discounted shares.
Let's run the math on how that discount operates because it's brilliant.
Go for it.
Suppose you hold a block of shares in your traditional IRA that was worth $600,000 at the market peak. A correction hits, and that exact same block of shares is now valued at $500,000.
Okay.
If you execute the Roth conversion at the bottom of the dip, you pay ordinary income tax on the $500,000 valuation.
Right. A lower tax bill today.
Exactly, but you still own the exact same number of shares. When a market inevitably recovers its previous high, that entire $100,000 bounce back occurs inside the Roth IRA.
Which means it is completely tax-free forever. It's like paying taxes on a clearance sale price.
Yes. If we connect this to the bigger picture of retirement planning, you are aggressively deflating the embedded tax bomb of future required minimum distributions.
You're accelerating a multi-year conversion strategy into a compressed time frame, simply because the asset valuations are temporarily depressed.
But there is a massive cliff hidden in this strategy,
Oh, there is.
particularly for those in their early to mid-60s who are nearing Medicare enrollment.
It requires surgical precision. Roth conversions directly increase your modified adjusted gross income, or MBI.
And Medicare premiums are tied to that, right?
Yes, to your MBI from 2 years prior through a mechanism called IRMAA, the income-related monthly adjustment amount.
And the thresholds for IRMAA are absolutely unforgiving. Looking at the projected 2026 limits cited in the playbook, a single filer faces surcharges beginning around $109,000 of ABGI.
And for joint filers, the threshold is approximately $218,000.
And it operates as a hard cliff, not a gradual phase-in.
Right. If your Roth conversion pushes your MGI one single dollar over that $218,000 threshold, you trigger the entire premium surcharge for the year.
Wow, just $1.
$1. The tax savings of the conversion can be entirely wiped out by the spike in Medicare costs if the advisor isn't simultaneously modeling the tax return and the investment portfolio.
Okay, so since we are looking at the mechanical friction of taxes and fees, it makes sense to examine how a high net worth portfolio handles standard rebalancing during a dip.
Because that changes too.
Right. In theory, rebalancing is simple. You trim the asset classes that have grown and buy the asset classes that have shrunk, forcing you to buy low and sell high.
But the execution of that theory is where amateur and institutional approaches diverge.
How so?
Well, a standard retail approach to rebalancing involves selling the winners in a taxable account to fund the purchase of the losers. In a taxable account, selling those winners triggers capital gains taxes, creating a massive drag on the portfolio.
So the high net worth approach avoids that. It's essentially refitting the ship while it is in dry dock, using existing cash flows to do the heavy lifting.
Exactly. Instead of selling off the assets that survived the correction, you take all incoming cash dividends, interest payments, or new capital, and deliberately aim the fire hose of that cash flow at the depressed asset classes.
You build back the target allocation without triggering a single taxable event.
Right. And if the cash flow isn't sufficient to rebalance the entire portfolio, you execute the necessary buy and sell orders strictly inside tax-advantaged accounts like IRAs or 401ks.
Because trades inside those accounts don't generate capital gains taxes. The Davies Wealth Management Playbook also highlights that a drawdown is the optimal environment to upgrade the underlying mechanics of the portfolio. They reference Morningstar research, which consistently shows that the lowest internal costs and the highest tax efficiency are the most reliable predictors of long-term net returns.
Yeah, and often, investors are trapped in legacy mutual funds that charge high expense ratios simply because they have held them for a decade.
Because the embedded capital gains are so massive that the tax cost of selling the fund outweighs the benefit of moving to a cheaper alternative.
Exactly. But a 20% market correction wipes out a significant portion of those embedded gains.
So the barrier to exit is lower.
Right. You can finally liquidate those inefficient legacy funds at a fraction of the tax cost and deploy the capital into low-cost index funds, or ETFs. You are upgrading the engine of the portfolio while the market has temporarily lowered the cost of the swap.
That is so smart. And this logic of using depressed valuations to solve structural problems applies exponentially if you have a concentrated wealth issue.
Which is very common for business owners or long-tenured corporate executives. Their net worth is dangerously tied to a single company's stock.
The rule of thumb provided here is the 10 to 15% rule. If a single stock or a single private business interest makes up more than 10-15% of your total net worth, a broader market correction isn't just a paper loss. It is a critical decision-making window.
Normally, unwinding a highly appreciated concentrated position is prohibitively expensive due to the capital gains hit. But during a correction, the math shifts entirely.
The share price drops, which means the embedded gain per share shrinks.
So you can distribute or sell more shares while staying within your target tax bracket.
The playbook lists several advanced structural tools to handle this beyond just selling the stock outright. Let's dig into the mechanics of these vehicles, starting with exchange funds.
An exchange fund allows an investor to pool their concentrated shares with a group of other investors who hold different concentrated stocks.
So you might contribute your concentrated tech stock, someone else contributes a pharma stock, and another contributes a manufacturing stock.
Exactly. You all receive a pro rata share of the newly diversified pool.
But the legal mechanism is what makes it work. Because of Section 721 of the tax code, contributing those shares to a partnership isn't considered a taxable sale.
Which is brilliant. You achieve instant diversification without an immediate capital gains tax bill.
However, the IRS requires a strict 7-year holding period. If you pull your capital out before 7 years, the tax deferral is voided.
Yeah, it's a trade-off of liquidity for tax-free diversification.
Makes sense.
Another vehicle mentioned is the Charitable Remainder Trust, or CRT. This solves both concentration risk and philanthropic goals.
How does that one work?
You irrevocably transfer the highly appreciated stock into the trust. Because the trust is tax-exempt, the trustee can sell the concentrated stock and reinvest the proceeds into a diversified portfolio without paying any capital gains tax in the time of the sale.
Wow. And in return for that irrevocable transfer, the trust pays you an income stream, either a fixed annuity or a fixed percentage of the trust's value for a set number of years or for life.
Plus, you get an immediate partial tax deduction based on the present value of what will eventually go to the charity.
So you completely bypass the immediate capital gains hit, create a diversified income stream, and fulfill a charitable intent.
It's incredibly powerful. And for those utilizing options, the playbook notes protective collars, buying a put option to floor your downside while selling a call option to finance the purchase.
All of these require the volatility of a correction to price effectively or execute efficiently.
They do.
But perhaps the most counterintuitive strategy in the entire document deals with estate transfer and the current federal exemption limits.
This is a big one.
We are currently operating under historic, massive estate and gift tax exemptions. In 2026, those limits sit around $15 million per individual or $30 million for a married couple.
But those exemptions are scheduled to sunset at the end of 2025, unless Congress acts, reverting to roughly half our current levels.
Which creates an enormous incentive to transfer wealth out of your taxable estate right now.
Right.
But the instinctive reaction for most people during a market correction is to stop giving money away. If your portfolio is down 20%, giving assets to your heirs feels like you are compounding the loss. Why on earth would you transfer an asset at its lowest possible valuation?
Because the IRS taxes the transfer based on the valuation on the day the gift is made. This is where the math of the tax code creates a massive opportunity.
Okay, break that down.
Consider the annual exclusion gift limit, which sits at $19,000 per recipient for 2026. You can give this amount to as many people as you want without dipping into your $15 million lifetime exemption.
Let's run the math on how a market drop supercharges that $19,000 allowance. If you own a stock trading at $100 a share, your $19,000 exclusion allows you to transfer 190 shares to an heir. But a correction hits, and the broader market drags that stock down to $50 a share.
Right.
Your $19,000 exclusion is a fixed dollar amount, so at $50 a share, you can now transfer 380 shares.
You are transferring double the equity, double the actual ownership stake in the underlying company, while using the exact same sliver of your tax exclusion.
That is unbelievable.
And the mechanical brilliance of this strategy happens after the transfer. When the market cycle turns and those shares recover from $50 back to $100 and beyond, all of that appreciation happens entirely outside of your taxable estate.
You are systematically gifting the recovery.
Exactly.
And for charitably inclined listeners over age 70 and a half, the playbook points out qualified charitable distributions, or QCDs.
Which is another fantastic tool.
You can move up to $108,000 per person in 2025 directly from your IRA to a qualified charity. It satisfies your required minimum distribution, but never shows up on your tax return as adjusted gross income.
Which keeps your IRMAA premiums down and avoids the taxation of your Social Security benefits.
So you are layering multiple tax code efficiencies, estate exemptions, ordinary income suppression, and Medicare premium management, using the market's temporary weakness as the driving leverage.
It's a highly integrated approach.
But none of this advanced architecture, not the charitable remainder trusts, not the direct index tax loss harvesting, not the IRMAA optimization, survives if human psychology breaks down.
And that brings us to the behavioral edge.
So what does this all mean?
Well, the financial damage of a correction is rarely caused by the market itself. It is almost always caused by the investor's reaction to the market. Data compiled by major asset managers spanning decades illustrates a brutal reality. The investors who suffer permanent, unrecoverable damage to their net worth are the ones who capitulate near the bottom and shift to cash, waiting for the market to feel safe again.
But the data proves that waiting for safety is mathematically disastrous. Missing just the 10 best days in the market over a 20-year period slashes your long-term returns exponentially.
It does.
And the cruel irony of market mechanics is that those historically best-performing days almost exclusively cluster right at the bottom of a correction amidst the absolute worst news cycles.
Which highlights the danger of consuming financial media during a drawdown. Headlines are engineered to trigger the amygdala. They monetize your financial anxiety through engagement. To counter this, the Davies Wealth Management Framework requires an investment policy statement.
In IPS, this isn't just a loose set of goals. It is a strict written governing document for the portfolio.
Crucially, the IPS must be drafted and signed during calm, rational market environment.
When you aren't panicking.
Right. It clearly dictates the rebalancing triggers, the liquidity requirements, and the tax loss harvesting parameters. When the inevitable volatility arrives, the portfolio management ceases to be an emotional decision-making process. It becomes a pure execution of a pre-existing legal framework.
And this reveals the structural difference between a commission-based broker and a fiduciary wealth manager. A broker operating a call center is essentially an order taker.
Right. A broker is not incentivized or structurally equipped to monitor your prior year tax returns to determine if a Roth conversion will push you over an IRMAA cliff.
Right.
They are not proactively coordinating with your estate attorney to fund a trust because your concentrated stock hit a valuation threshold.
They just execute the trades you asked for. But the strategies we've unpacked today demand a fiduciary who possesses a total integrated view of your balance sheet.
Because the liquidity architecture, the tax alpha, the estate planning, they all interact.
Pulling a lever in the taxable account instantly changes the math on your Medicare premiums and your estate exemptions.
Execution without integration is just creating new blind spots.
So true. Let's rapidly synthesize this framework so you can audit your own financial architecture. First, verify your liquidity shield. Do you have 12 to 36 months of cash flow totally insulated from equity markets, preventing any forced liquidation?
Second, prepare the tax loss harvesting process. Ensure you have the direct indexing or fund swapping mechanics ready to bypass the wash sale rule.
Third, calculate your exact IRMAA thresholds and Roth conversion capacity before the dip happens.
Fourth, establish a mechanical trigger for any concentrated asset that crosses the 10 to 15% net worth threshold.
And finally, coordinate with your estate team to ensure your gifting strategy is primed to transfer assets when valuations temporarily collapse.
It is a rigorous list, but consider this underlying reality. We possess overwhelming historical data proving that market corrections of 10 to 20% occur roughly every 1 to 2 years.
They are the mathematical price of admission for capturing the equity premium over time.
Exactly. So if we know the exact frequency and magnitude of these events, and we have the exact tax code mechanics to capitalize on them, why do we continue to treat an entirely predictable cycle like an unprecedented emergency?
What a great point to end on. Take a long look at your own architecture before the headlines turn red. Thanks for joining us on this deep dive. We'll see you next time.